on the show, you've used the term a few times, but the trending topic of the week is when you say legging into a position, what exactly does that mean? Legging. What is a leg when you talk about options trading?
Right. So a lot of our option strategies, remember, options SIP can be uh, they can be structured in up to 27 different ways, I think is how many the mathematicians have come up with. You can so with options, we have the choice of expiration dates. So we're going to use standardized options. These are the ones that are sold on the broad market. We're not going to have any custom options that you have to have, like a lawyer negotiate the contract on. We're going to use the standard options that are sold just like stocks. And so when you pick an option, first of all, there's the type, call or put. There is the strike price. So choosing different strike prices will actually make the option behave differently. Choosing the expiration date, whether it's one that expires in just by the end of the week or one that expires in 2 years from now, that's going to make the option behave differently. And finally, we can combine two or three options or maybe even a stock trade, combine them together to get these things to behave the way we want them to. Depending on what we see in the broad market or what we see on the individual security, we can construct a multi leg strategy that'll profit on that situation. Now, I use the word legging in because once you've planned out this multi-faceted trade that maybe has two or three or even four option trades in it, or different options or stock option combinations, you don't have to actually do the trade on all of them at once. That would be applying the strategy as is. And a lot of people do that. Like, for instance, a lot of folks are attracted to strategies like iron condors or vertical or calendar spreads, like we've talked about for our earnings play. That's where you put on all the option trades all at once. The other way to do it is to leg in, put on one part of the option strategy per time, let some time pass, let some movement in the underlying symbol or the option parts that you've already put in place happen, let them age or mature, and then add the other parts on gradually, and then take parts away and add them back, so on and so forth. In fact, that's what my big premium selling program is all about. It's about setting up a initial like trade and then adding and subtracting the different legs over time to create income streams where you leave that initial trade intact and you're just constantly doing these adjustments. And when I say constantly, I don't mean daily. I mean like once a month. You're doing an adjustment on these positions and you're legging in. And so the timing on legging in is the real trick, right?
And I was just gonna say that that is basically the leg is time, right? Because options have, either you're buying something that's 6 months down the path or something that's 3 weeks, right? They kind of work together and you
Mhm,
need one before you need the other, or you need the
mhm.
other to kind of coordinate, or just, it helps alleviate the multifaceted movements, right? And time is one of those components, price is one of those components, and I guess it can be a little confusing for a newbie, right?
That's right. I mean, that's what my program participants and I probably spend the most time on is when are we going to leg into each individual position? What's going to tell us? And a lot of times, and I know this because I deal with it daily, a lot of people make it more, you can make it more complicated or simple as you want. Simple would be just doing all the legs at once. Now, the benefit to spreading that out over time is if you do some front end analysis where you have the like for instance my analysis on the S&P, I knew this was going to happen, this pullback and all of this stuff. So putting in some effort into the front end analysis and setting for yourself actual targets What that does, if there's a good positive movement in your position over a short amount of time before you put the next leg on, what putting the next leg on later in time does for you is it increases the reward and it decreases the risk. But it does require that front end analysis, right? So a lot of folks question, should I do a lot of effort on the front end and then, just follow this trade plan and follow my price targets as the position matures? Or should I just throw this strategy on, let it do what it's going to do, and then throw another strategy on more as an active trader? And here's my experience, Sip. My experience doing it both ways over the last 2 decades is if you do that front end work, yeah, it's kind of a pain in the butt on the front end, but then you have not only these positions that have higher reward and less risk, but you also have positions that wind up lasting longer in time with less intervention, less adjustments. And so I have found doing both of them that if you can set up and plan a trade thoroughly on the front end, it's going to last longer and pay more and have less risk involved with it than if you're more active in the real time trading, if that makes sense.